Web3, it is about reinventing how your business is structured, and that's how you disrupt the companies and compete with innovation, and not just by upgrading a technology. You need to penetrate the attention in a sharp bursts of marketing. You need to do that consistently in a short period of time, not consistently over a long period of time, because the narratives play a role in how your campaign works. The market changes so fast on what marketing strategies work. You cannot plan 3 months before and then execute a campaign right now. You need to plan 1 week before and execute your campaign right now. The crypto world is like walking on landmines. You should not put your feet on that one wrong mine. It is not about the one thing that you do right that makes you successful. It is the 99 things that you don't do wrong that makes you successful. You can do something great and then die because you made one mistake.
Do you think Memecoins solves this problem?
Memes have more liquidity than most of the technical projects these days, so they will always be part of the narrative and they'll attract people to come to the space. I just don't think they will hold the business value, but they will hold a lot of community value, social interest, and attention.
What's the insights and recommendation you can give for our audience?
Be patient, study, know what you're getting into, understand the space inside out, take your time to know what you're getting into, because you'll always have another opportunity at something, but you'll never have an opportunity if you lose your hope. So hold on to your hope, and the best way to do that is by learning, studying more, getting better insights, and growing your own common sense and knowledge of the space.
Greetings everyone, I'm your host Kirill Ivanov, and today my guest Karnika, or Mr.Key, a blockchain expert and founder of Key Difference. Hey Karnika.
Man.
It's great to have you here.
Really?
Could you introduce yourself, who you are and what you do?
Sure thing. So I was in the world of marketing 17 years ago, and I found Web3 because some of the companies I was working with, they started using Bitcoin. This was in 2013, 11 years back. So when I got into Web3, I found that the philosophy of what I represent and what blockchain world represent were the same. So that was my start, and it's been 11 years of journey ever since.
It's so long.
Yeah.
So long period of time. Okay.
From the early days, I've been part of almost every different kind of business, stakeholders in the Web3 space. I've helped exchanges, launchpads, investors, and many other parties in the marketing world back then. And in 2017, I was part of crypto news media outlets. So that gave me a whole different direction when I was working with the guys at News BTC, Bitcoinist, and when I incubated Cryptopolitan and many more. It was a journey of being part of the news world, and during the same year, part of the ICO space. It's about $550 million supporting ICOs back then. And this set the path of being part of the Web3 industry from a different perspective. And that's the year I also started having my own fund. So we started a family office, started investing in various liquid tokens and venture capital deals ever since. So being part of the fund, being on the marketing side, the news side, helping many other companies in the Web3 get started, and got me into quite a lot of businesses and their perspectives. That was the start of my journey, and I felt that to be incredible, because being someone on the outside and knowing what happens in the industry is one thing, but being part of those businesses and knowing how they operate and what they need really is a different thing. So right now, Key Difference is 17 years old and 11 years in Web3. And Key Difference has 4 major divisions. One is our go-to-market hub in Dubai, which is our accelerator, where we help businesses to do the right things from the product to the business, token, and so on, to launch successfully. And when you say launch, not just their token, but their actual business product to get the users and grow towards a Series A. So we have an obsession towards fundamentally strong companies and real companies. You've seen enough of shitcoins, and starting 2013, I started with Bitcoin shitcoins. So we've seen all of that. So we focus on fundamentally really good companies. We have our fund, which is on the venture capital side, and we make investments on the businesses that we believe in. And the next part is our marketing side of the business, our oldest blockchain marketing agency, which has been the cornerstone of everything that we did from early days. We were working with a lot of clients until 2021, but after that we said this is very, very vital resource and we need to protect it. And we only used it for ourselves and our portfolio companies ever since. And finally, the Newswire product, which is the best newswire in the space right now. That's like a brief of what I do and what Key Difference does.
Okay.
There's a lot of other businesses that we are part of, that we own, that we run in the space, but I think that's good for an introduction.
It sounds cool, but can you share some specific numbers about your company?
Sure thing. So we have about 120 people and $550 million raise so far.
Okay.
We have worked with over 110 plus clients from the start till now. And every one of our businesses, the four major verticals, they are fully independent of each other and they function there. So what other numbers would you need? I have a portfolio companies of over 140 companies that we invested in, some very large names that we can dive in later to the startups.
Okay.
This year, we have done about 45 investments, and our liquid fund is twice larger than our VC fund. So we have a lot of investments on the liquid side.
It's insane. I would like to discuss the opportunities and trends in crypto for 2025, especially for retail market. Where should we focus our attention?
The crypto is in a beautiful spot right now. We have seen many different cycles, and every cycle had with it something new, something unique, like the NFTs of 2021 and
exactly.
memes that always existed and so on. But this cycle is a cycle of institutional era. You're seeing a lot of institutions come in. You have ETFs launched. You have many bigger companies like Sony recently acquired an exchange in Japan.
Really?
They launched their own blockchain, and you see what MasterCard is doing and what all these larger global institutions are. And most of the conversations I'm having right now, they're all based on traditional companies leveraging blockchain as a technology or leveraging the financial side of the Web3 world and so on. So with that being the situation, you would see a lot of regulated or permission companies, regulated offerings, and so on come up. So that is a new institution era in the Web3, which we have not seen before because institutions were shy away from the Web3. This will open up doors to new kinds of investment products in the space and derivatives. So even closed DeFi would come in, which probably banks would be the leaders of it. On the other side, as these traditional companies are coming in, they're going to bring in a lot of M&A opportunities because they said, guys, go figure out this industry, go figure out Web3. We don't want to, we don't believe in this. We don't want to fight in this. They left us for 10 years and now we have found different amazing products and solutions. So now these companies would come in and buy the companies out. They don't want to build, test, R&D it. They want to buy something that works. So now as they buy it, it starts a beautiful M&A opportunity across this whole space, not only for the companies that existed, but companies that are being created right now. In the next 3 years, we will see companies merging into one. Because at this point, I had a lot of interesting conversations with many established founders, and the biggest concern is there are no users, there are no developers. So you're basically sitting in a space of a lot of technologies, a lot of products with no users and developers.
Yeah, exactly.
Right? So now they need to merge. You need to bring them all together, and that is what I see as the biggest trend. So now if you use this as a base, institution era and the M&A opportunity, now start thinking about the retail opportunity, which is a mix of these two, which is consumer apps which has consumer possibilities, infrastructure which can attract a lot of consumers, like what Ton ecosystem is up to, and many more. So focus on consumers and users would be the biggest and the most important factor in the space. So it is no longer Web3 consumers. It's Web2 business with Web2 consumers leveraging Web3. So exactly. Web3 playing that the middle of the patty of the sandwich role moving forward.
Okay. And I want to ask a mainstream question about Memecoins. Do you think Memecoins solves this problem, how to bring audience to blockchains?
I think Memecoins are doing a great job at that because Memecoin represent the culture, they represent the fun, they represent speculation, gambling. And Memecoins are also about community. People are in the world where right now with social media, everybody is lost. You don't have friends, you have social media friends, and people are just looking at the world and they want to belong somewhere, and Memecoin gives them a community where they can belong right now. You just go, you buy a meme, and now you're a back holder and you're part of a new community. You're associated to that community because you believe in a character, or you believe in a culture, you believe in a trend, you believe in a political party, you believe in a pain of losing something, and now there's a meme on that. There's a meme on everything. So now you're basically having some community group that you can be part of. This is almost like what you had in the Americas back in those days of having support groups and having social clubs and all of that, but in a global scale. Now you can just support, be part of any word, phrase, character, meme. So memes will be there. I don't think memes will be gone. In fact, memes have more liquidity than most of the technical projects these days. So they will always be part of the narrative, and they'll attract people to come to the space. I just don't think they will hold the business value, but they will hold a lot of community value, social interest, and attention.
Okay, what you mentioned, is it good from one hand, but the other hand, a lot of people use meme coins and want to earn money, make money, just do flipping. What's your personal opinion about it?
Well, anytime you ask me about blockchain, I say that blockchain is a philosophy more than technology, and the philosophy of blockchain is all about freedom and choice. So if people choose to use blockchain for speculation, for trading, flipping, gambling, then that's their choice. They can use it. There's nothing good with it, wrong, bad with it. It's their personal choice of what they want to do with their time, with their money. If they want to use it for something else, like the technology and business opportunity it presents, that's also there.
Yeah, I totally agree with you. But do you believe in meme coins, or do you buy some memes?
I personally don't. I do have, I've tried few memes, yes. I had my part of my success with it as well. But I don't have the required time and the short-lived focus on the memes. You need to be there. You need to watch it, put the money and keep looking at it and act on it. And that's not something that works for me personally. So I don't touch memes, but I had my share of fun with them as well in the past.
Okay, it's interesting. But if we're not talking about memes, do you consider some other altcoins or different cryptocurrency to buy and invest in it?
Well, at this point, there are a lot of infrastructure in the Web3, which has which has a lot of potential, which is great for people to buy. And with the last, let's say, 1 year of progress, you can see what could be in the limelight. There are a lot of layer ones and some of the layer ones, layer twos that has a great potential. But again, there's a huge competition with that market chains. Now you have like thousands of chains, and nobody's going to use all the thousands of chains, and they don't have users. They're declining. So it's mostly marketing to drive attention, and they cannot hold, and there is a challenge with it. So if I have to personally make some picks, I've been always an Ethereum fanboy for many, many years, irrespective of what the market could say and what people could say. I believe strongly in Ethereum. So Bitcoin, Ethereum, Solana, Ton, these are 4 of my personal picks because they have community, because they have users, because they have a unique value which others don't have.
Telegram have 1 billion audience.
Correct, exactly. And Solana has a very loyal community. Ethereum has the best infrastructure in the world at this point in the blockchain ecosystem. That's why many layer ones and other blockchains became layer twos of Ethereum, because there's no other way for them to continue growing and expanding. So I think these 4 blue chips are what I would consider as the liquid, safest investment havens. Of course, they all carry risks. Anything can go down anytime. If HPO finds Satoshi Nakamoto, you would be in a soup tomorrow. But these 4 are positioned in a good way for this particular market right now.
Okay. What's your personal strategy and personal approach to find blue chips projects? You mentioned about some layers 1, but if we want to do due diligence, how do we do it correctly?
I think the due diligence process has many parts to it. The diligence based on, let's start with the speculative part, the market narrative. Is this a narrative that's an interest in the market? Then you go towards their ability to acquire users. What is the niche that they're targeting? Do they have users? Do they have interest? Can they attract them? And then the viability of that market, like the gaming market that we saw, the metaverse. There's a lot of interest around it, but then there is difficulty converting those users and retaining them. So it's also important to figure out the viability of it in the short term and the long term. So if your investment thesis is, I'm going to invest for the next 5 years and I'm happy to profit in the next cycle, that's a different view. Then I want to exit this bull market with the profitability. Then you need to look at different objects. So depending on your investment thesis, you need to find if it works or doesn't work. And then the team. Who's the team? If they're public? Do they have capability? Do they have experience? Do they know what they're doing? And again, also to decide if the people listed on the team are really the team, because a lot of times it's like advisors and people who are not involved, just a picture on the face, and that doesn't count. So it's finding if they're true and validating it. And the technology, a lot of times you can write a lot of chat GPT garbage there with, okay, chat GPT use all these complex words and the trend words,
Yeah, exactly.
make a white paper out of it, but does it make sense? Is there really reliable industry people backing it, being part of the journey and supporting that particular thesis? All of this counts. So a diligence to me is not a matter of looking at the team advisor photos and the VCs and looking at the size of the Twitter, Telegram and jumping in. Because if you want real good opportunities, you need to jump in before that. Yeah. And if you need to jump in early, you need to do your study. You need to know what you're backing, what do you want to be part of, and which one can grow. And what can grow also has a lot to do with the marketing. A great technology, which is not marketing, is also not going to make it out there. So an amazing tech which has the team members or community who is willing to market that and put it out there in the right way, and a right roadmap matters. And again, a roadmap is not a lot of text on there, but their ability to execute on that. So to me, an diligence process is like a 200-point checklist, looking and studying of every single aspect that it takes hours and days. And a lot of times when you review a project, you don't know what you're looking at. Maybe you are good at blockchain, you review the blockchain side, but it has a real world connection and you don't know that industry. You're not going to know every industry in the world. You need to speak with people, talk to people in that industry, that sector, to understand if this even makes sense. Because we had that quite a bit. People come with a TradeFi product, we talk to TradeFi experts, and then we know that's a bullshit. Yeah. Right? Just because TradeFi was hot and Web 2 to Web 3 was hot, Web 2.5 was a trend some time back. A lot of TradeFi projects were cooked up, which made no real world sense. It made nice deck, but nothing beyond that. So diligence means going beyond your knowledge base, talking to real experts and validating it, because the founders are always smarter than investors, right? Because founders know their subject. They spend 10, 20 years or whatever their experiences in that industry and that sector. So they obviously know more. So when you're trying to validate someone who's smarter than you need to work with other people who are even more smarter to get the feedback. Of course, there are patterns and you can use the patterns to figure things out, and you don't need to know answers to everything. Being a good judge of people and their backgrounds can also help. But to me, it is an elaborate process in deducing what can work and projecting onto a business model that can be sustainable.
What is your top tools for analysis?
The brain.
No, any recommendation?
Well, it depends on what you're really working with, but I think it's usually in the network and your own common sense and brain, really. If you're talking about an DeFi mathematical thing, maybe there are tools for simulation and computation, but it's really people, your network, who you know, who you can connect with, and your own mind to apply. I don't think there are shortcut tools and softwares that help you to understand, because a lot of times if you look at it, early stage companies, you're not investing in the product. You're not investing in the business. You're investing in the founder as a human, as a person, right? Because it's not even a team, it's the founder. The founder who has the resilience, the persistence, and ability to not give up, but change with the time and go make things happen. Because the product, before it receives investment, can easily pivot 3 times. The product that you invested and the product that finally gets the investment round closed are completely different. They will change at least 3 times. And after getting the funding, they will pivot 3 more times before they find their product market fit. The business will change quite a bit. And finally, the revenue models that they end up with would have nothing to do with what the founder initially spoke about. So why invest on something that is not going to be there? You're investing on the potential of a founder and potential of what they can accomplish. It's the person that you're investing in, not the product or the company or the brand name or the people involved in the team who can all change in the journey of the next few years.
I also want to ask a question from other side. What's the main red flags in investing, especially for you?
Red flags, that's quite a lot. It can start with the fluff. I hate fluff. So when we look at a business or a deck, it's very easy to find those without substance, where they just filled it with all the jargons. Okay, now Deepin is hot. Then you find a deck which says AI, Deepin, this, that, all the keywords. It has every keyword. How does that all work together? There's no answer
Yeah,
to
exactly.
it, right? So you
see
can
this
find a
every
lot
time.
of those fluff. And you can also see businesses which are short-term based. Like, for example, when the Egan layer was starting up early this year, quite a few DeFi products came about. And from the time that happened to the Egan's airdrop that's happening right now, a lot of those companies' lifespan is over. They might not survive the bull market. They might not even be alive when the bull market starts. And how would you want to be part of it? Because it's challenging. So for me, red flag is not just with the product, the way it is pitched, but it is about the survivability of that particular company. Are they designed to survive the next 3 months, 6 months, or can they live for a year, 2 years? All of that matters. If you're on the top of the bull market or you're entering the bull market right now, it's okay to invest in a company that will only live for 6 months, because there's bull market and that makes sense. But it doesn't make sense early this year. It might not make sense in a bear market. You want a sustainable company. So if you want to have a portfolio that is not an glorified meme coin, you need sustainable businesses that can produce revenue, can produce technology or IP, if not revenues, can be valuable to someone. If not for a consumer, it should be valuable to be acquired by someone else. So I would just broaden the perspective of what it means to have a client and the value provided, and see to it that the business can sustain itself for the next 3-5 years, at which point it makes sense. Like if you just look at any business, like look at Chainlink, for example, or Polygon, Ethereum, Arbitrum, they didn't start 1, 2, 3 years ago. They've been there 5 or more years, 5 to 7 years. And that's how they built themselves. And it took them time to grow, to acquire customers. So if a company is raising the fundraise that they're looking for, I would be wary if they're looking for too much or too little. There's a balance to it. What is the round size that they're looking in the current time, and does that round take them to the next step? If they're trying to raise $300,000 and they're living in the United States of America, I have big doubts that they are looking at doing anything substantially. Or if they're trying to raise $20 million on a seed round and they have zero previous startup experience or zero network to be able to sustain that kind of a fundraise, that's also a challenge. So it all boils down to the red flags are not black and white. It's not saying this is wrong. Is this right for this founder, for this product, in this industry, in this market timing? And that's what matters. It's a subjective red flags. It's not very objective in most instances.
What do you think will be strongest narrative in 2025? You mentioned about institutional era, but it's like general.
Correct. So,
general description.
Real world assets are great.
Okay.
Real world asset infrastructures are even great. I am bullish on meme infrastructure, not the meme coins, but the infrastructure for memes.
For fun.
Similar to that, there are quite a few infrastructure that can be developed, which doesn't exist right now. And I know some of the startups that are on the job, mostly because meme is here to stay. And there's a lot of money going towards that from the retail. And if there's an infrastructure that can work, there's a lot of potential around that. Deepen, I am not so bullish in the short term. Deepen could potentially take a better center stage in the next few years to come, but not necessarily just this cycle. Anything to do with a fund infrastructure, that is DeFi 2.0, but with an institutional support, that will do really well, because most of the RWAs, again, are part of institutional DeFi, and that is important. Payments are super important. Anything to do with payments, you have quite a lot of payment companies, payment processors, and etc. But I can just ask you, do you know of 1 or 2 companies that you would want to use for like a tap and pay or a card processor in the crypto space? There are just quite a lot, but there's no strong winner. That is definitely an area of opportunity. And UX focused wallets, gasless US focused wallets are great. You do have some of them right now, but again, no strong winner. There's still market for it, and wallet infrastructure itself is great because there are too many individual wallets, and if someone develops an SDK and wallet infrastructure with which many entities can depend on that they can build, there's an opportunity. There are a couple of them in the market, but there's room for a lot more for innovation on that part. Anything to do with abstraction of technology is great. That is user experience and abstraction that removes the complexity of blockchain, like signing through social, signing through email or MPCs and so on, anything that enhances the user experience to hide the blockchain behind the scene, because we are done with the era of having blockchain on the forefront. You don't want to see MetaMask, you don't want to see wallet, you don't want to see wallet address, you don't want to see a transaction hash, you don't want any of that.
Yeah.
You want a simple user experience. Go deposit your
simplify.
money, use your card to pay or use your crypto card to pay, fund something with a tap and start using it and start signing things with your biometrics, process it and be safe, secure, and confident with what you're doing, and easy to move between all the apps. Doesn't matter if one of the dApps is in Solana and the other dApp is in Optimism and the other one is in Sui, but you want to be able to move between them, which ideally means there is infrastructure right now, but the infrastructure doesn't have the usability and user experience strong enough to do it, like layer 0 bridge. There are limitations to it. So we always talk about the cross-chain parts, and there are quite a bit of that, but they're ecosystem individualized. So if you're within Optimism, maybe you have something. If you're within Cosmos, you have something. Within the whole of EVM, you have something. But the moment you start moving outside, you have challenges, which is where you have solutions like the SVM, the Solana's EVM take on it. There are quite a few of those coming up, which are basically bridging the technologies, and anything that deals with the user experience and the real-time bridging will have a lot of potential. Liquidity pooling will have a lot of opportunity, because right now DeFi liquidity is scattered across multiple chains, scattered across multiple ecosystems and multiple dApps. So how do you unify the liquidity? Similar to what 1inch did, or Cow Protocol of Genesis did in the DEX space. You need unifying liquidity across the rest of the DeFi space as well. You have a proliferation of stable coins right now. That is the biggest, lowest hanging fruit for institutions right now. Everybody's launching stable coins, which ideally means you would have a lot of stable coin based infrastructure, stable coin based, leveler. I don't know what is the right word to use it, but if you have 10 different stable coins, how do you get on a place where you unify them? So you would end up having platforms which does that part of it. So it's almost like saying you have US dollar, but 20 different US dollars, but you don't accept the US dollar that I want to accept, but it's all US dollars. And now you need something that unifies that process, like a DEX, which swaps one-on-one with the small commissions,
to simplify
it.
Process,
so it's almost like a payment processor, payment exchanger, a DEX for stable coins, like Curve has, but with an user experience considered for dApps. So it opens up a Pandora box. Your question opens up a box in my mind of so many different things that needs to be fixed in the space. And governance. We know DAOs did not work very well in the crypto space, but now with institutional adoption, there will be DAOs coming up, because it will not be DAO for an project's future, but a DAO between employees of a company, a DAO for customers, for product voting, product feature voting. There'll be a lot of DAOs coming up which are non-commercial DAOs, non-investment DAOs based on a business value and a business process. And the governance there will take a lot of important place. I recently also see there are a couple of countries, crypto countries popping up, like Liberland on one side, and there's one more that's raising funds to become a country, which ideally means there is an infrastructure behind things like that. A larger scale DAOs or larger scale governance or government models that is emerging on chain. Although I wouldn't consider that to be a hot emerging trend, I do see that to be an opportunity of validation in the market. A lot of these trends, and all of these trends are important and vital for blockchain adoption right now.
Yeah, I think it will be enough. Last question is this direction. What the projects you hold in your portfolio now?
Quite a lot.
If it's not a secret.
I hold a lot of layer ones, almost many of the layer ones. Let's start with the Bitcoin, Ethereum, Polygon, to the Ton. Quite a lot of investments on there, Solana and so on, the layer ones. But other than that, some of the DeFi 1.0 protocols. The reason why DeFi 1.0 is because DeFi 1.0 is proven to stay. Their infrastructure is still here. They're alive and they're not dead. And any surviving DeFi 1.0 products like Aave and many more, they have a good future in the years to come. And I have some of the exposure there. I think these are the two major categories, I would say, and anything on the infrastructure side as well.
Okay. I want to talk about how extremely AI growing now. And what do you think about how AI can impact on blockchain industry, and where is benefits for us?
AI and blockchain are two disruptors. They both disrupt the space, but they both disrupt the space in two different ways. AI is in need of data, and blockchain can be the data marketplace. AI needs to pay a lot of people for their data. Individuals and organizations, and those are micropayments, and blockchain can enable those micropayments to work. So blockchain is the marketplace, the payment infrastructure for AI, and the resource infrastructure, because AI requires a lot of compute power and nodes, distributed nodes, computing power from the world can be a great revenue model for multiple parties, and the infrastructure is a place blockchain can help. The other part blockchain can help AI is with the trust part. AI is Trust is the biggest problem with AI, and blockchain can fix that. So these are four components where blockchain can support AI. Where AI can support blockchain, it is on simplification. Blockchain is complicated. We talk about smart contracts. Everything is in the code, but nobody can read that code. AI can help you read it. AI can help comprehend a lot of complex blockchain user experience. So it can add value to the user experience side of the blockchain and blockchain applications pretty much. So that is one major part of AI contribution. And of course, it can help all the people in the blockchain world to get their work and shit done faster.
You mentioned before about RWA tokenization. I heard about it everywhere. Mm-hmm. Everyone talk about RWA like it will be a strongest narrative and big technology perspective in the future. But if I'm a beginner and I'm not understand technical process, can you explain how it's exactly work?
Okay, so real world assets, RWAs as it goes, it just means that you want to represent an asset that exists in the real world, in the world of blockchain. And you can do that in multiple ways. You can do that by representing the dollar value on chain. So for example, it's an asset, let's use a car.
Okay.
If you want to start tokenizing Uber, because Uber makes money. Uber drives and the cars, taxis.
But Uber on the stocks, how you tokenize
not
them
the Uber itself,
time.
But I'm saying the taxis.
Okay.
Let's say you want to tokenize taxis, create a platform like that. Now you could, the price of a car is probably $50,000. Now you can create 50,000 tokens that allows people to own the share in a car that makes money and receive the income from there. So basically, you're just representing the dollar value in here and allowing people to buy into the equity of a token of a particular real world business and or either a company or an asset itself, and that enables them to profit from it. So now they can curate liquidity from public, so they don't have to expose their capital intensive nature. So this is great for real estate or assets like ships and helicopters that we have been involved in, or even water as a commodity. Gold, you see quite a lot of that happening, or gold mines and many more. So they're all capital intensive, and you want some community to offset that capital intensive nature, because banks don't always do that, and in return you share the revenues that the assets generate. On the other hand, you can also do that by representing the share certificates on chain. It's another way of doing it, where a company and SPV shares are represented as NFTs on chain. You can use that to basically buy and sell and trade, although the liquidity is a matter of question there. So ideally, in an RWA situation, it is just an ability for people to access a real world asset in smaller transactions. If you want to go and own some asset, like let's say a real estate property, you need to put in $1 million, $500,000, $2 million, whatever the case may be, or you want to own a hotel, it's 10, 15, $20 million. It's not possible for every individual to do that. And if you go with $1,000 to an apartment, I want to own a small part of it, it's just not feasible. They cannot legally do anything about it. But with real world assets, you can do that. So anybody can invest, okay, this month from my salary, someone in any part of the world, they say emerging market, I can only put in $10 of my salary to this month, and I want to invest in it. And they can do that. They can buy $10 worth of an asset. And that just makes this so much more interesting, because it does two things. One, it brings the liquidity of billions of people, not millions, but billions of people on chain, where they can put their money and be part of something. So now you're curating asset, because the good part of the world is bankless. They're unbanked. So now not only depending on the liquidity there, but you're opening up to everybody in the world, and their little liquidity to big liquidity, you can tap into that, which means you have more liquidity concentrated for you as a real business. On the other hand, individuals right now, they only have an option of putting money in the bank as a bank deposit, which is super limiting because now you get what in countries like Dubai, you get 4-5%. In many other countries, you get 1-2%. It's so low. But these assets, like yachts, produce about 12%. Solar panels produce 12% annual returns. Ships produce 20 to 40%.
Also with conservative approach. Oh.
Exactly. These are conservative
Makes
numbers
sense.
of what these assets produce. You're talking about 12 to 40% in many of these assets because that's what business earns. This kind of takes me back to the conversation and the book from Robert Kiyosaki, where he talks the Rich Dad Poor Dad, where he speaks about how wealth is created. You need to get out of the rat race. Rat race is getting paid for your time, salaried job, and then putting the money in a bank and the limiting things. He talked about real estate, talked about owning businesses, owning assets, and you cannot do that in the real world with the little money, and you can now do that in a tokenized world, which ideally means it enables every person from the first dollar they earn to play the big game and be on the big table the same way all these amazing high net worth individuals had the opportunity and privilege to do. If you can own a helicopter, which only billionaires and millionaires in the world owned, and you can charter that and make money out of it from $1 and earn 40 cents out of that in the year, that puts you in a very powerful place. You don't have to stand in the bank and wait for your fixed deposits to mature for you to withdraw the money. You don't need that. So it is changing the status quo of the world. It's bringing in paradigm shift of how the financial world is going to think, how people can invest and change their lives for themselves, how businesses can source liquidity in ways that was previously not possible at a lower cost or a better cost or in a better share. And it is also changing the business models fundamentally from thinking there's one founder and few employees and then customers, merging the world of customers, investors, community, and bringing a new model of functioning. Because right now, a community always vouches for the investments they do.
Okay.
So if you have a strong enough community of people who invested $10, $20 into your solar panels that you're tokenizing, now everybody's going to talk about your business to everybody else, not because they're your customer, but because they're your investors. They care about the future of your business. So you just convert everybody into your ambassadors or evangelists, and that's a powerful change to a business model. It changes business models. That's what I want to highlight. It changes fundamentally how you think about business. Web3 is not about putting blockchain in the place of an SQL database. It is about reinventing how your business is structured, and that's how you disrupt the companies and compete with innovation and not just by upgrading a technology.
Okay. What do you think about regulation issue? Because what you told about RWA tokenization is really a good perspective, but process of realization and company who will realize this technology, it's really difficult to fight with regulation issue.
I started working on RWAs in 2017. I had real estate tokenization clients in 2017, and I worked with...
And how they work?
They all converted themselves into Web 2. They basically started as a Web 3, tokenized this, tokenized that, and then they found regulatory challenges, and then they just made their business Web 2 business, eliminating the blockchain out of the scene. But right now, you have an opportunity where regulation is caught up to a decent level. I wouldn't say 100%, but you're there at a point where you can launch a successful RWA business in a regulated world and function, mostly because you also see companies like BlackRock and many others completely being bullish on the space. So it is practical right now. It's not easy, but it's practical compared to 2017. So you can run an RWA business, but as time goes by, it'll become more and more easier, and a regulation will catch up. There's no way around it. If regulations don't catch up, there'll be a black market, and the governments don't want that. Governments want to tax it. They want to profit from it. They want to see things happen within AML compliant and without money laundering happening. They want to see that in the right way. So there's a good incentive for them, because this is no longer 15 people doing transfers among ourselves and being happy with pizzas from Bitcoin, but right now it's a global phenomenon, and they need to be part of it, and they are willing to be part of it. And you can see that through governments like in the Middle East, like what UAE is up to. They are taking steps forward. And if they don't take steps forward, the business moves away to countries like this, where people are willing, the government is willing to support people on that.
Okay, makes sense. So you have good experience to helping companies and projects to scaling in web, especially in Web3. So let's imagine if I am a builder and I want to build startup, what top 3 marketing tips for promoting project?
Okay.
Which you can give for some people who build projects?
Understand your customer. Your customer could be multiple parties. Are you looking at the crypto moon boys, or are you looking at your products customers? Know who you're communicating with and adopt your message appropriately. This is one of the things that Memecoins did a great job at. They built a strong community because they know who they're talking and they know how to address it. Know that. Use a 360-degree marketing approach. Don't just think one of the things, oh, everybody right now is behind key opinion leaders because they think that's the only thing that works.
Right.
It is a combination of multiple things. You need the right key opinion leaders. You need the right media for validation. You need the right people with you that talk about you and like your investors, etc. in the crypto community. You need multiple pieces of the puzzle in the right time. Your strong social team, your strong content team, and everything that goes in between it. It's not just one element. There are dozens of elements that put together a great campaign. While it's great to obsess on Pareto principle of 80-20 on things that's great, producing the most impact, don't forget to cover your bases. You need that 360-degree coverage. Otherwise, you do a great job at one, you fail at other. I always say in the crypto world, it is not about the one thing that you do right that makes you successful. It is the 99 things that you don't do wrong that makes you successful. You can do something great and then die because you made one mistake. The crypto world is like walking on landmines. You should not put your feet on that one wrong mine. And if you do, everything else that you did right matters none because you're burnt, you're dust. So it's super important to take that careful steps and do the right things to not make that mistake. And the third important part, I would say, is to be strong in grabbing the attention. This is an attention economy, and you cannot run a marketing campaign for 6 months or 1 year. If you run it in a short sprints and do it strong enough that everybody hears you. This is the biggest mistake that Web 2 marketers do when they enter Web 3. They apply the Web 2 marketing principles, but Web 3, hello, it's not Web 2. It's Web 3 is different. It's different. It's tribal. It's there's a lot of attention grabbing things. You need to penetrate the attention in a sharp burst of marketing. It's like a shotgun. You need to do that consistently in a short period of time, not consistently over a long period of time. And you need to have clear objectives, KPIs. What am I trying to accomplish? Get in, do that, go back to your drawing board, figure out, come back, because the narratives play a role in how your campaign works. The market changes so fast on what marketing strategies work. Yeah. You cannot plan 3 months before and then execute a campaign right now. You need to plan 1 week before and execute your campaign right now. So it requires ability to be fast, amendable, and swift. So these are the 3 core components, I would say: knowing your customer and working with the 360-degree approach on marketing, and finally doing it the Web3 way in the right speed and sprints and not a marathon.
Okay. Also, fundraising is important thing for entrepreneurs who building projects. Can you give a recommendation how to do this process right?
Okay, so fundraising comes with trust.
Because it's really sensitive.
It is. So how does the fundraising market work? Let's take some steps back, because this requires understanding behind the scenes on how investors think and investors work. Who are investors? You have angel investors, you have friends and family investors, you have venture capitalists. The friends and family invest in you because you nag them and you're in their living room and you won't go out until they give you the money, which is great. You know how to do that. The angel investors do because they believe in you as a founder, your vision, what you stand for, the logic, your business makes sense to them, and they're happy to support. But the biggest money comes from VCs. And how do VCs invest? Where do VCs get the money? VCs get the money from LPs. So VC is not investing their money, but they're investing someone else's money. And who are these LPs? Bigger angels or high net worth individuals or funds of funds, or funds who receive funds from bigger institutions, organizations who invest in other funds. So these guys, VCs, have a mandate. They have a thesis. They have a limitation on what they can invest, what they cannot invest, and what criteria they invest in. And they want to produce returns to their investors. So they're not here to do a charity. They want to make money, because only if they make money, they can make money as a managers of the fund, right? They can give the money to their investors.
Correct.
And they make money, profit from. So if that is the intention, they are looking at many factors like the ones that I initially we had a conversation in about the fundamentals, the business, the structure. Does it make money in the narrative right now or long term?
Right.
Based on their thesis of how they're looking at the horizon, there are some VCs who look at short term, some VCs who look at the long term. When you approach for fundraising, think about these factors. Who do you want to raise the money from? How do you want to raise the money from? And when do you want to raise the money from? If you go to the biggest institution investors or biggest VCs, the timelines might be long. You need to have relationships. You need to be able to stand their strong diligence to win it. If you believe your project is strong enough for that, great. But start getting validation. Can you attract first get the money from friends and family. If your family and friends don't believe in you, then others are not going to. And then get the right angels, the people who can support you, people who understand the space, who can be a value addition. Because angels come in at an early valuation and they take the risk and they also put in the effort to support you. Crypto VCs, most of them don't support you in your journey. Traditional VCs do a great job. Traditional VCs stay with you in the journey, support you out. But unfortunately, crypto VCs are not there yet. The industry is a bit more immature to do that. They're more obsessed on money making, that they don't support their portfolio enough. But I believe in the future cycles that will change, especially with institutional VCs coming into the scene right now. So know who you want to have with you. The people who can support, people who have portfolio, who has potential clients of yours, people who are strong in a particular region, territory, who have reputation there. Because if you can just think about the fundraise, if it's big enough, then getting investors from famous ones from different regions would be great. Famous ones from different industries would be great. And the people that you like and they can deliver value to you, getting them is great. But this is a qualitative approach. If you look at this qualitative approach, you need to be good as a founder to be able to do that. If you're capable of that, your product is good, it can stand the test of the diligence, and you want to raise the money from the right people, take this route. If you know you're a shit project, then please stick with friends and family and the angels around you, and upgrade yourself to a level where it is good enough before approaching any quality VCs. Alternatively, in the early this year, you saw a lot of key opinion leader rounds. Products which are more B2C can benefit from things like that because now they have KOLs part of it and they can promote it, they can market it, which will be great for onboarding consumers. Every company raised key opinion leader round, but if you ask me, B2C products and consumer apps and anything that focuses on attracting the end user, they would benefit a lot more, and the KOLs would benefit a lot more from engaging on something like that than a hardcore B2B application, except in certain instances. So fundraising is a strategy, and if the investors can see that you have a clear strategy of raising funds, they would rather trust you. Everything in the world is a psychology, right?
Yeah,
if you say no to investors, the investors want you more. So think about the psychology of fundraising, think about investors' mind and create that. Investors speak among themselves. Every investor speaks to other because they share the deal flow, they share the interest, they want to make sure their portfolios get funded. Before they invest in, they want to make sure their friends are investing or they're stupid. They want to validate that, so they talk among themselves. So if you have a bad reputation with a single VC, consider your fundraising round extremely hard because they talk among themselves. If you have a good relationship with a few VCs, as a friend, as an individual, then you will have an easier job in the process. Fundraising is a relationship game. It's a long-term game. Don't go to the VC market when you want to raise funds. Be in the market all the time and build relationship, because relationships pay off later. So think about it from a long-term perspective and have good relationship at all times with people. I've seen founders come and say, hey, right now I'm not talking to VCs because I'm not raising any money. I'll talk to them in 6 months. Sure, but when you talk to them, you're going to take a few more months to build a relationship. Unless you're growing like a great product, great traction, everything is great, then the VCs will flock to you. Sure, if you're a founder of Telegram and you want to do that, that will work. But if you're like most founders, you need relationship in addition to a great product because there's a lot of competition in the market. So it's a hybrid of things. Like everything in the world of business, it's not a black and white checklist of things, but having the right product, right founder mindset, right relationship, and going to the right people that can support your business and help grow your business would be the ideal case. And of course, the world is not ideal. So you got to do things that are not always necessarily the right thing to do. That's founder's life. But these are the principles and guidelines to go through.
Okay, makes sense. It's really valuable information. In which situation, in which cases people can come to your company? In which cases you can help and what you can do?
Okay, quite a few. So if they're a Web3 company or a Web2 to Web3 company and they want real knowledge, intel, guidance, and support in building their business, we are very happy to support them through our go-to-market hub at key difference labs. And this is for serious, fundamentally strong founders who are looking at making a difference out there. And it can be a Web3 business, it can be a Web2 to 3 business, it doesn't matter. But we're looking at real good companies that we can support in that in key different labs. If there is an business that wants support on the marketing side, or whether it's a go-to-market token product market, that is something that we can help with across the whole life cycle of the marketing. We have done that few hundred times, raised $550 million and more. It's something that we can do with our eyes closed. If they're looking at some press, PR exposure, our newswire and our connections to all the crypto news media outlets can really help them. That's an area that we can support. And of course, investments at all times is the core component of many of the things that we do. So these are areas where we can support. But beyond that, to me, interesting idea in the crypto world, I'm always full on for that because it excites me. It's something that we're all passionate about. And that's why we are in this space.
Okay. We'll put links on description who are interested in it. What is your prediction and what do you think about future of finance world on next 3-5 years?
I think a good part of the traditional finance world, TradeFi, is going to slowly move and merge with the Web3 because even the Swift transactions, MasterCards and others are exploring to replace with an interbank settlements on crypto. So you're looking at the whole of the traditional finance, the world of finance, getting an upgrade in crypto in the years to come. Everything represented as a regulated, permissioned crypto asset. We might not see it that way. It's just like CBDCs coming up. It's not the crypto as in our traditional sense, but it uses crypto as a technology, blockchain as a technology. It will not be a USDT or USDC, but they will be using the infrastructure behind the scenes. So I see a great potential on the growth of that infrastructure in the coming years.
Okay, and final moment, what's the insights and recommendation you can give for our audience?
Be patient, study, know what you're getting into, understand the space inside out, not just look at a key opinion leader's post and jump into it because someone says so. Take your time to know what you're getting into because you'll always have another opportunity at something, but you'll never have an opportunity if you lose your hope. So hold on to your hope. And the best way to do that is by learning, studying more, getting better insights and growing your own common sense and knowledge of the space. That's like the honor one of crypto for me because most people who entered crypto and ran away from it did the stupid thing. If they do the smart thing and the right thing, they would stay for multiple cycles and they will have a great future. But this cycle to me is the last cycle of this nature. The next cycle, it's going to be more boring with full of institutions. So this cycle is the last of the crypto cycle the way we know it. And there's a great opportunity now to act now. So spend all the time you can, all the energy you can to get up to speed, run your business or create things or invest in the space. Whatever you want to do it now.
Okay, thanks for joining. Really excited from our conversation.
Sure thing, man. Take care.